Well, we're down to the last 3 days of January, and you would think we could just kind of ease into February, but that's not to be. There is a lot of data about to hit the market that could affect bonds and mortgage rates a lot this week. So I want to dive into a little bit of that so you know what to expect. And we'll go through the main points that actually did affect the market on the update next Monday. First of all, Janet Yellen, the Treasury Secretary, has announced that there's going to be a large amount, some unknown quantity and various maturities of debt that needs to be purchased that's going to be on the market, right? Today, this afternoon, and also on Wednesday. So it'll be interesting to see how the buyers that are out there are able to absorb this massive amount of U.S. debt that needs to be financed in order for our government to continue to function. This wasn't received well a few weeks ago when we had a 5-year auction and there was too much quantity of supply out there, so there and not enough buyers. Hopefully that doesn't happen this time because that could cause interest rates to rise, right? If there's not enough demand for something on the, especially on a bond side, then you want the yield will go higher to entice more investors to want to invest and get a higher return on their investment. Right now, the Federal Reserve is not a buyer. They haven't been for almost 2 years, right? April, May timeframe will be 2 years since they have been a buyer of any debt, any bonds, mortgage-backed securities or otherwise. So what do we have left? Well, pension funds, mutual funds, foreign countries, excuse me. So is there enough demand for what's going to hit the market today and Wednesday? We'll see. That will affect the market to some degree. Now, also what's going to affect the market is the Federal Reserve has their meeting starting tomorrow and Wednesday. After the meeting, they have a press conference. They release a statement. And if they change even just 1 or 2 words, right, if they change the inflection or the meaning of certain sentences in their statement about what they plan to do in the future and how that will affect the market, that can really affect the market, right? It can move markets. Jerome Powell has to be very careful and choose his words wisely because the market is expecting that the interest rates will not be changed during this meeting, but that they will start changing in March and especially in May. So depending on his wording will affect how the market responds and interprets his policy statement, the statement of the Federal Reserve as far as when they will start cutting rates and to what extent they'll cut rates over the course of the year. So it'll be very interesting to see what happens there. The Fed has plenty of information to digest, including last Friday's PCE report, the personal consumption expenditure report that measures the consumption expenditures of the entire country. That came in lower than expectations. We're down to the 2 handle now for a 12-month rolling average. It was 2.9%, so dropped from 3.2 to 2.9%. That's good news for inflation, which should help the Federal Reserve be more comfortable cutting interest rates sometime later this spring. What they're looking for is 2% on that core inflation. We're at 2.9. We're getting there. Now, if you look at a 6-month or a 3-month, 3 to 6 month rolling average instead of 12 months, which it's actually right there at 2%, right below and right above, right around 2%. So we're getting closer, but they want to see that 12-month rolling average closer to 2% before they feel that much more confident in aggressively cutting. They may start cutting rates on the Federal Reserve federal funds rate. They may start cutting it actually before they hit 2%, as long as we're on the path towards that. So we'll see. This will be interesting to see how they interpret that as part of the other data points they look at. Lastly, we have the ADP employment report on Wednesday, measures private payrolls, and the BLS government report on Friday. These 2 numbers tend to be wildly divergent. Like they're not even in the same universe sometimes, especially in January, because January includes a number of seasonal adjustments plus a population control adjustment that the BLS has started adding to its January reports the last few years. If you recall last year, the population adjustment caused the number of jobs, right, that job gains to be above 500,000. And without that population adjustment, which includes mostly, to be honest, a large chunk of that is migrant labor. If that wouldn't have been included, it would have been in like the high 180s, below 200,000, which would have indicated a weaker job market than what the headline made it sound like it was. Now, of course, the markets react to the headline, right? So the higher the employment numbers, the better the Biden administration looks, frankly, and the stronger the economy looks, even though it may or may not be true. So this month, you kind of have to take with a grain of salt. January's over time have tended to be kind of higher numbers than reality would indicate. So I'm going to kind of take it with a grain of salt. Now, if it comes in low, right, let's say it comes in below 200,000 in that 150 to 200 range, even with the population control and the seasonal adjustments, that would indicate a much weaker economy than expected. So we're going to have to watch this closely on Friday, see what happens, and see how it affects interest rates come Monday. All right, with that said, let's dive into the charts here. What we're looking at here is your universal mortgage-backed security chart. And this is showing that prices have been kind of stuck in a range, as you can see here, right? For about a week and a half. We're stuck between the 25-day moving average and the 50-day moving average on a technical level, kind of getting squeezed. Not terrible squeeze, but there is some squeeze going on here, which is difficult because when it gets tighter and tighter in that range, there's more likelihood that data can cause the price to bounce out one way or the other and have a kind of an outsized movement, right? So we hope that doesn't happen, but what we do hope is we see prices increase because that means yields and rates would be coming down. The 10-year Treasury is this chart, and that is a leading indicator of mortgage-backed securities, and that is in a tight range. It's very much in a squeeze between that 50-day moving average and 200-day moving average. If it gets thrown out of that because of data that may indicate the Fed's not going to cut rates as soon as possible, or employment's hot, or what have you, there's a lot of room to the upside here on the yield, and that's not good, right? If this yield goes up, that means rates are going up, and mortgage-backed securities, mortgage rates tend to follow that 10-year Treasury as a leading indicator. So let's hope that doesn't happen. Going to be a lot of information this week. If you'd like a recap of any of these videos, I post them on my YouTube channel as Guiding You Home with underscores in between. So guiding_you_home, or look up Guiding You Home Bill Zimmerman and subscribe. And then you can see going back a number of months in these rate updates and refer back to it, of course, during the week, and share that with clients and with friends and family that you may know who may be interested in purchasing a home or looking at, okay, what do I make of this data? What direction do I expect interest rates to go? Because really the movement of interest rates is really what's most important. And those movements tend to last, right, for weeks and sometimes months before turning around and going a different direction. So hope this was helpful. We'll talk to you next Monday.